prepared a paper for this conference, and it's sort of the first, in a sense, academic paper I've written for about 30 years. My background, as anybody who was at the dinner last night will know, I was the treasurer to Martin Taylor at Barclays, and we tended to get on pretty well, and we tended to share the same view about a lot of things. And a lot of my thoughts on this came from 2008, when I met Martin at a conference, and I retired from Barclays after 32 years, and he had left, and he said, if we were back at the ALCO, Asset and Liability Committee of the bank, which was held every month, and you were on one side of the table, as you always were, and I was on the other, and we were telling you, the head of the retail bank and the head of the investment bank, what the commercial position of the bank was, and you were telling us what the balance sheet issues were, what would you be telling me to do right now? And I said, well, quite simply, Martin, it was a very instinctive reaction, don't lend anybody any money. And he said, oh, okay, so why? I think you probably already knew, but he said, why? And I said, well, it's very simple, Martin. I can control the balance sheet, or we can control the balance sheet, but we can't control capital markets. So if I need to go and get more capital because the balance sheet has grown, I don't know that I can find that capital, particularly as I will likely to be in competition with a lot of other banks at the time. Because if one of us has a problem, we're all likely to have more or less the same problem. Now, that was not quite as true in that crisis as it, and I will cover that quite separately and probably not today, but that wasn't quite as true in the crisis as it had been previously. A number of banks developed different strategies and different business models. And primary amongst them actually was Northern Rock. So one of the things I often get concerned about is people taking Northern Rock and assuming that everybody's strategy looks somewhat like Northern Rock's. Northern Rock was a very particular strategy and it produced very particular problems. But I have to say that's a different story. But getting back to the main story, it was what is the reaction function of a retail, very largely Barclays Bank, a very large commercial bank in the UK, what is the reaction function to different issues that affect it? How are these banks going to react? Because that is the thing that a central bank needs to understand, in my view. And it is the thing that I think central banks just completely lost the plot on. It's not just my view. Paul Tucker used to appear in my office quite regularly, interestingly, in those days. And we would discuss, and a central theme of his discussion was always, we just don't know what's going on in financial markets anymore. We're just observers. And we used to be participants, we used to know what was happening. These days we just observe. And frankly, what's going on mystifies us in many instances. So we go through what was happening in securitisation markets, what was happening in derivatives markets, etc., etc. And we're trying to build up a picture of what we thought might be happening in markets in general, and where that might be leading us. Now, that obviously, I was an economist by background, so that interested me in that, and I ended up attending the financial markets group at the LSE, and that's why I got to know Charles so well. And as a treasurer, which was very unusual, but it was a huge learning curve for me. But I hope it's a learning curve for a lot of other people, because I think this concept of what's the reaction function is central to how central banks need to evolve an understanding of how banks react, how banks operate. Central to that, and it's a point I'm going to, there are 6 points in this paper, and there will be eventually 8, but one of the points, I'm going to focus on one of the points. Today we've heard a lot about regulation, and as a board director of a bank these days, and I've been board director of several banks now, that doesn't make a lot of sense to me, because we focus a lot on Bar 2, we focus a lot on the sort of, that's a tick box exercise. I'm going to exaggerate a bit, but that's a tick box exercise. That's, are we conforming to the rules? We do not have a committee that looks at that at board level. What's the committee at board level that really matters? The audit committee. The audit committee is fixated on what we are reporting to the market. What does our report to council look like? There's 2 guiding principles there. One is we can't mislead the regulator. One, well, probably most of the important guiding principle is we are legally responsible for that document as a board. That is up front centre of our thinking all the time. We are legally responsible. The other one is a qualified audit means the end of the bank. So we're not going to get a qualified audit. So the auditor is by far the most important regulator we have. And the international financial reporting standards, which are absolutely dominant in this area, are the reporting standards which matter most to the board. It doesn't want to breach its regulatory requirements, it won't, but anything that happens on, if it breaches IFRS, it's a dead duck. So basically that's the one that we're really concerned about. And that is the regulator, which never gets mentioned, or doesn't get mentioned anything like enough. It is an international regulator. Only the US conforms to other standards, US GAAP, which are not that dissimilar. There are some differences, but not that dissimilar. But IFRS is completely dominant globally. So I've had this conversation with the Central Bank of Indonesia, which I was advised to at one stage. This is the dominant set of standards in the world. It is a global regulator that acts entirely under its own discretion. In my view, incorrectly so. I have no idea why central banks, and this is one I'm going to defend the Fed on, the Fed is much more robust in its reaction to US GAAP. The US Fed is not required to follow US GAAP when it defines the capital requirements of US banks. That is not true in the EU and the UK, anywhere in the European Union, because the European Union has to follow IFRS in defining its capital. That is, I think, an enormous problem. Why do I think it's an enormous problem? Because we've moved more and more towards mark-to-market accounting. Today, the difference between a commercial bank and an investment bank, which is where I did most of my growing up, I have to say, when I was head of structured products with Barclays Capital. So nobody knows much more about securitisations and the structures I did. I worked for Salomon Brothers in New York on this, on securitisations. The whole structure of the way in which we look at a bank as a board is much defined by IFRS. And IFRS is riddled with problems from a regulatory perspective. And central banks don't make anything like enough money. Why that is, I really don't know. Because, as I say, the Fed seemed to get onto this pretty quickly as far as US GAAP was concerned. We don't define capital that way. We're free to define it however we like. EU, we have to define it this way. The problem with that definition of capital, or defining capital by the standards of IFRS, is that as we move more and more towards mark-to-market, we move the retail bank to look more and more like an investment bank. Because its capital is defined by whatever market prices are at a point in time. That, I think, is terribly problematic for retail banks. It is going to become the defining issue of the next, in my view, it's going to become the defining issue of the next crisis. Because we're going to find that bank capital can just die once. Markets are subject to mark-to-market. Mark-to-market can often become mark-to-panic. Because markets panic. If we look back at, there's a document in here that I refer to, that by the Bank of England, Europe, is the only joint paper from the ECB and the Bank of England. It's joint paper, and it looked at the changes in the default rates of securitisations, particularly in the UK, they had a lot of data. During the crisis. During the crisis, the actual default rate on these bonds these securitisations, averaged 5 basis points. And that's 0.05% of 0.05%. In the crisis, the mark-to-market was based on 5% plus default rates. So 100 times higher than the actual default rate that occurred. That's how big market panics can get in very secure securities. That it consumes capital at that point in time. Your capital is not marked to the average, it's not marked to the end result, it's marked to that point. Moreover, under IFRS 9, you will be expected to carry that as expected loss through all of your businesses. So you are projecting those sort of rates, not just then, but for all time in the future. Highly unlikely than projecting the recovery. So my view of this is that it's a whole area of importance to banks, which central banks don't really understand, or regulators don't understand. It's an area where regulators have been, I'm tempted to say, to some extent, willfully negligent. I think that they don't really want to know the problems. I think they're beginning to, but I don't think they have in the past wanted to know. I think they wanted to think this is all about accounting and it doesn't really matter. And largely because we're run by economists. And actually, if we were run by accountants, we'd be frantic about this. So I think there's a big difference. And if we were run by bankers, we would be just as frantic as the accountants, frankly, would be. But we certainly wouldn't be as phlegmatic on it as the economists are. There is a view that it doesn't really matter because it isn't real, which it is. It's very real, and you have to do it. It's completely real. This is money you are going to have to find. And you are going to have to create reserves to account for it. Now, loan loss reserves are a story all unto themselves, and one of the things that I've been listening to today has made me a bit concerned, it's been discussed, is that how we define some of these things, because one of the things I had to manage when I first became a treasurer was the enormous losses Barclays suffered in about 1990, when there'd been a huge, and yet another property crisis in the UK. My whole career in Barclays Bank was founded actually in the property crisis. My first job in a branch in 1972 was to drive around the country because I actually had a car. And in 1972, that wasn't most of the junior staff didn't have. I was on the second MDP program, management development program they ever had. To which one of the questions by the board, incidentally, because we were interviewed by the board in those days, was why on earth would we ever want a graduate in our bank? But besides that, I had a car, so I was driving.
You've only got 3 more minutes.
Oh, okay. I was driving around trying to find the properties, and I drove past, down this road, going to the local pub. Said, "Where's this property?" He said, "Oh, you won't see that. It's not high. It's high tide at the moment. You've got to wait till the tide goes out." So that was kind of my first introduction. The 1990s one was very much how do we carry this losses forward. And remember that when we make a provision, that isn't a loss. Provision turns into a loss. We write the loss off. We don't write the asset off. We do not write the asset off. We hold on to whatever security we have with a view to selling it later. If you look at the 1990 crisis in Barclays and the decade after it, write-backs and recoveries in that decade always exceeded write-offs. And though we wrote off $1 billion in 1990, we wrote back significantly more than that over the next decade. I remember one particular sale where an asset that we had a loan of 20 million turned into a freehold holding of a very extensive set of properties in Southampton, which turned into 200 million sale. If you look back at that whole period, that billion never lost it. Now that, to me, was a story that I tell you because it's profitable. What are values? They're not always prices. The price of something at a point in time can be very different from the price of it over time. And banking is essentially a business which has to look over time. That's what we want banks to do. We want them to look through cycles. We don't want them to become the creature of cycles. But everything we are doing in regulation is creating them as the creature of cycles. And the bit of regulation that is doing it most is accounting regulation. And that is the thought I want to leave you with. That the big regulator around here is not the central bank. It's the International Accounting Standards Board. Thank you.
Thank you very much.